Welcome to the Risk Reversal Podcast. Guy Adami, always joined by
Dan Nathan.
Yeah, and today we have another Dan.
Only Dan's here on this side of the desk.
Dan Greenhaus, of course. Chief economist and strategist at Solus Alternative Asset Management. Last time Dan was here was July 25th. Dan was bullish. Dan was right. Dan has been right, by the way, for quite some time.
That Dan. Just to be
Dan
really
Greenhaus,
clear.
just to be crystal clear.
Yeah, okay.
How are you, Dan?
I'm doing so wonderful. It's there's not a scale to.
Well, you should be doing wonderful because, I watch the various shows that you're on, whether it's Closing Bell, whatever show they have you on, the Overtime. You have been one of those voices that you need to listen to. You sort of cut through all the nonsense that people like myself talk about and you get right to the point. And
I don't think everything you say is nonsense.
I would think you would think 70%.
Whatever the percentage is, doesn't matter.
Between us girls. Anyhow, here we are. We're doing this on a Thursday, full disclosure. So the market's seeing a bit of a sell-off, not a big deal. I mean, we have an S&P that's effectively making new all-time highs every day. So let's go from July till today. I don't think a lot has surprised you, is my sense.
No, we don't have the data, which is a problem. I mean,
let me ask you, I don't mean to say, is it a problem? Because, whether we had the data or not, I don't think anything would necessarily have changed. That's just my instincts.
I think that's probably right, but more data is better than less data, of course. But as I was arguing at the time, we still have ADP, you still have the National Association of Realtors, the National Association of Home Builders, plenty of private sector economic forecasters and data providers still are going to give you data. And then most importantly, you still have companies. I still go to conferences. You still hear from management. And I'm much more focused on what companies have to say than I'm more focused on what companies have to say than the macro data. And you still have that, obviously.
I know this is a generalization, but in general, what you've heard from companies, is that sort of galvanized, reinforced your belief system? Have you heard any things that have surprised you?
Well, this is a good conversation at this moment. On balance, I think earnings season's gone very well. Not in terms of 75% of companies beat. I don't care about any of that.
Right.
I'm talking about the way companies talk about the environment. And yes, you have Chipotle, although I would argue that's idiosyncratic.
That seems to be it's Chipotle specific, and yeah.
No, but I would also add that the thing everyone points to is Brinkers and how well Chili's has been doing as a counter. But I would argue that's also idiosyncratic on the upside. We know the low-income consumer is strained, if you will. Increasingly, it appears if maybe the middle-income consumer is strained. But Chipotle seems to me to be a very idiosyncratic story that's been several quarters in the making. You could have at the time, and I did argue the same thing about Target. There was a moment where Target's issues were macroeconomic, and I didn't think they were, and I still don't. So when you step back from the worst outcomes, there are issues. The restaurants, problem, residential construction. You heard from Lennox Industries and the home builders that the drop in mortgage rates we've seen hasn't necessarily translated into a big increase in traffic. So there are weaknesses throughout the economy. But then my favorite, and I talk about this every quarter, you can do no better in terms of your macroeconomic analysis than listening to the conference calls of American Express, Visa, MasterCard, and Capital One.
True.
And now, granted, American Express leans high income, sure, but everything was great there. And Visa, I don't remember exactly what MasterCard said, but Visa said, again, we've seen no change in consumer behavior across income cohorts. And again, remember, Visa captures everything. It's not just restaurants. It's not just mall-based retailers. It's all the spending. And they're telling me everything looks good.
And I agree with that. That is exactly what you hear. And American Express, I'm going to put to the side for a second. But for MasterCard and Visa, and Capital One to a certain extent, well, MasterCard and Visa, processing transactions are going higher. One of the things that I've thought, by the way, it hasn't come to fruition, is people are fighting inflation with, by spending, with putting things on credit. So is there anything to glean from that? Does from what your work has suggested or seen, is anything suggest that people are in fact getting over their skis a little bit?
I don't know when to determine people are getting over their skis. Sentiment measures, not like the consumer confidence measure, but when you poll people, they're furious about prices.
Right.
And they've been furious for a while. And you see this from the consumer staples companies. When Kellogg and Post, Kraft Heinz report, the revenue number might be up, but it's all on price. Volumes have been going down quarter after quarter after quarter. And that's consumers obviously shifting their consumption basket away from discretionary items and towards the staples. You hear that from Walmart and Target, et cetera, Kroger. So I don't really know when to say too much is too much. And I think that's a theme of mine for some time. A lot of people point to idiosyncratic measures and say, oh, look at the Challenger grain Christmas measure, or look at the Philly Fed fell to its lowest level. You got to look at the totality of the evidence and the hierarchy of the data. What's more important, what's less important, and look at a wide breadth of it. And so there are always things that you can point to say, aha, that's not great. But what is the totality of the data telling me?
All right, so let's get to what the Fed said last week, because again, I think some of what you just explained is some of this debate that's going on within the Fed. And make no mistake about it, it really did seem like a debate, right? Heading into that meeting, it was near a certainty that we're going to get another 25 basis point cut in December. I think Fed Chair Powell obviously put some cold water on that. We have the CME Fed Watch tool, I think is pricing in now a 72% probability of a 25 basis point cut. To Guy's point about the data and not having it, I think it probably makes the whole thing a bit more difficult. But when you think about this push and pull between weak labor, which we have, that's the last piece of good data that we had on the labor market, and then inflation readings, which we haven't had a whole heck of a lot of inputs there. But to your point, there's lots of other ways to glean that. And it seems like this is really this battle right here, right? And so how do you think this kind of resolves itself? Because, Trump's trade war with China, it seems like it was just a kind of a push out. No one can come back and say, this is great. I think our good friend Peter Boockvar just said, hey, listen, our soybeans, their rare earths, maybe semiconductors, who knows where they stand. I mean, this is where it was all going to come down to. So we have inflationary pressures that still are there. We have the weak labor market. We have inflation that's sticking around. What do we do here? What does the Fed do next? And why is that important, I guess, to the mosaic here?
Jay Powell at the press conference the other day told you they don't have any idea.
Yeah.
And I don't mean that in a pejorative or a negative way. You've got Stephen Myron, obviously dissenting for 50, dissents for no change. I think he was reflective of the reality that there is no consensus. I never thought December should have been as high as it was. I still think it should be about 50-50. And his tone yesterday suggested that he's not even sure if 50-50 is probably 50-50 might be too high. I don't know what they're supposed to do right now. Right. You don't have a lot of data on which you normally rely. You did get two cuts out of the way right here, and that's good. I thought the Fed policy rate was too high. You're now closer to something resembling neutral. And not to get into an esoteric discussion here, but when the Fed funds rate is way above where it should be or way below where it should be, you can feel comfortable hiking by 75 basis points 4 meetings in a row because you've got a lot of room to get where you're supposed to go. Right now, there's a lot of uncertainty. Do I need 1 or 2 more cuts? I don't think anybody really thinks you need, quote unquote, need 5 or 6. I shouldn't say anybody, but you don't need 5 or 6 more cuts. So when you start getting closer to where they think the end result is going to be, which is the mid 3s, I'm not surprised, especially without the data, that they're going to take a little bit of a breath here.
So what you just described, and I don't want to put words in your mouth, but it's not a rate cutting cycle. It's a rate sort of tweaking period of time that we're in. We're sort of, just cleaning things up around the edges. And I would submit,
the insurance cut description people use.
Insurance cut. Okay. And then the fact that I think the offset of not a foregone conclusion may have been ending QT in December, although a lot of people thought they would announce that end at this meeting last week. They didn't. But December, to me, was sort of the offset of the not a foregone conclusion, because I think a lot of people also thought that would start in January. Not that that matters all that much, by the way. Thoughts on that?
How many people on Twitter and on TV talk a lot about the Fed providing liquidity, and now we're tightening liquidity and the overlay of the Fed balance sheet with the S&P 500. Mm-hmm. So I don't think it matters nearly to the degree a lot of other people do, but a lot of people do. And for those people, the Fed balance sheet is going to stop shrinking. It's like 6.6 trillion or so, and should start expanding now, but not for reasons of QE, for easing financial conditions, if you will, but just because that's what the Fed normally does. The amount of money and the size of the balance sheet has a steady upward tilt to it.
So I know you do work, and I'm not. And if you don't, I don't know the answer to this, but I'm asking you, somebody that may. The Fed should have a balance sheet based on a number of different things, money, so all different things out there. So let's just say, for sake of argument, it should be baseline $5 trillion or so. It shouldn't be 10 trillion, which we got close to. I guess my question is it about right where we are? Have you done work to suggest we're probably where we should be in terms of that?
So to frame it, before all of this, let's call it 2007, the Fed balance sheet was about $900 billion.
Less than $1 trillion.
Less than $1 trillion.
Yeah.
And there was basically none of this. There was some easing around the edges in 2001 in 2000 for Y2K. After September 11th, the Fed provided some liquidity. But otherwise, the Fed is just accommodating demand for currency, swaps overseas, et cetera, et cetera. And there's just a very steady upward move in the balance sheet. So it was called $900 billion. So you mentioned the $5 trillion number. The right way to think about it is really as a share of GDP.
Right.
How big should the balance sheet? And then how many reserves are in the system? And so what the Fed saw in the last couple of days was some very minor tweaks in the in a couple of really esoteric money market measures.
Repo market.
Parts of the repo market that made them say, all right, we're closer to the level that we think. We don't want to play any games and have a dislocation like we did previously. So let's just stop here and play it safe.
Thoughts on the bond market, which again, when they cut in September, yields briefly went below 4%, went up to 4.17, I think, back below 4%. As we're sitting here today, they've made a move back to, I think, 4.1%.
Give or take.
Does that mean anything? I mean, is the bond market trying to sniff something out?
I don't think the short-term moves, the larger move, we came into the year 480, I think it was 482, something like that on the 10-year. You're now at 410, so call it 75. I'm making it up, 75 basis points of decline. That trend is what's ultimately important in terms of how you think about cash flows, et cetera, in your model. So, but intra-week, those types of moves, no, I don't think there's anything like what would the bond market be?
I don't know. I'm asking you because you watch these things. I'm trying to figure out if the bond market is sniffing something out. If they're sniffing out that, all right, the Fed just showed their hand a little bit. This repo market, maybe they're concerned about. Maybe we can start to get ahead of it. I'll also say we're in basically November now, if you think about it. And Jerome Powell's out in May. And historically, the bond market or the market loves to challenge new Fed chairs. So I think there might be, at some point, we're going to start to see some of that, I would think.
Yeah, it's very possible. Right now, with respect to the Fed and the bond market and the equity market, et cetera, the overriding theme, I don't think investors should spend very much time, or listeners to this call should spend very much time thinking about the Fed balance sheet.
I agree with that.
I don't think that's really of relevance to you as an active trader at all. As we go into next year, we have a pretty good economy. Obviously, we don't know everything because some of the data is not around, but it did just grow 3.8% or so in the second quarter. It's probably going to grow somewhere around 2.7 or something like that in the third quarter. You have the seasonally strong end to the year, which carries over into January, February. And you have a Fed that is on balance accommodative, maybe not as accommodative in the next 4 months as it was in the previous 4 months, but still leaning in that direction. And corporate profits, even outside of the Mag 7. I mean, obviously, we're going to talk for a minute about the companies that reported last week, but see what I did there?
Yeah, good job.
And but even outside of that, I have a list of companies that did very well.
All right, so let's talk about some of the contributors to that growth, right? And so we've seen a lot of the data of late. We know that normally, 2/3 of GDP, right, is this consumer. We just talked about the consumer. We got this K-shaped situation here, but let's talk about these companies that are contributing a great deal to GDP growth, right, going forward. And you think about it, we just got through listening to how all these hyperscalers continue to raise their CapEx at lower growth rates than they have in the past, but the numbers are getting really big, right? We're talking about hundreds of billions cumulatively, and we're seeing that is obviously a big part of the stimulative sort of environment that we have in our economy. How important is that? And how, if we pull back, so let's just say you have a company like Meta, right? And they make their money selling digital ads, right, to consumers from brands. And if brands see less demand, they're going to pull back on advertising, right? And that has to do with a weakening consumer, right? So then you would think that at some point, if you're Meta, you're going to pull back from that CapEx, right? And so if that
some of it, sure.
Well, they're going to have to, right? Like, just think about that. And they already learned their lesson in 21 into 22, right? With Reality Labs and all this. So you see where I'm going here. There will be a point, whether it's 2 quarters from now, whether it's 2 years from now, I think it comes sooner than that, where you see a pullback in that CapEx. What do you think it means for the economy here? Because it really is a huge driver of this economic activity we have here in the US.
So with the caveat that it's enormously important.
Yeah.
It is the single largest driver of what's going on in the market by far. I don't think it's quite the driver of the economy that some people like. I've seen some analyses that have argued if you X out data center investment, the economy is barely growing. I think that's probably a stretch, but it's certainly a contributing factor in a noticeable way. I wouldn't say a meaningful
I think it's like 1% of a 2% GDP right now.
Yeah,
on average.
There's ways to do it that are a little lower than that, but whatever it is, the consumer is still the driving force of the U.S. economy. So about the spend, I think it's whenever we're on TV, the host inevitably asks, "What's more important, the Fed or AI?" I don't even think it's a debate. I think it's the AI story.
I agree with that.
By
100%.
By 100 million miles.
Jamie Dimon, a year or so, 2 years ago, I don't remember exactly when it was, but he basically said what you're saying is that people like Guy Adami, he didn't use my name, but people on TV spend way too much time opining about the Fed. He didn't think it was as important, not nearly as important as we make it out to be.
And just to drive home this point, here's some examples. I don't know if I need my glasses.
Wear them, though. You look good in glasses.
We'll see what the ladies say.
Yeah.
What is it? I guess I'm probably 55 to 64-year-old demo. That's
no, I disagree with that. I think you probably skew a little younger than that.
We'll see who writes in.
Fair enough.
Ladies, vote with your email. Okay.
Men
Men
too.
too.
Amanda's email, by the way.
I'm not exclusionary. So for me, it's more than the Mag 7, and I've made this point on air. I think Stephanie Link and I are probably, in terms of CNBC personalities, if you will,
in lockstep.
I mean, personality is a stretch for you, but
sure, people who appear on air,
yeah, okay.
we're probably the two that have been arguing other stuff is going on as well, industrials, et cetera. So I do need my glasses. I apologize. So Amphenol, which is an APH, sales in the quarter grew 128%. EQT, Nat Gas Company.
By the way, EQT, to the extent that you care, is the E in my tube. The stock do this acronym game. The stock, as you know, it's been $52 stock like forever. But to your point, yes, I saw that as well.
All right, but can I just ask you a question? No. APH. No one's ever heard of Amphenol.
Oh, I have.
You have.
One of the best performing names in the S&P 500 this year.
Okay, but what I want to say is I'm looking at what they do. I guarantee you they sell this stuff into AI data centers.
But this is the point I'm making.
Oh, EQT.
So when the royal we think about what's going on in markets, I think a lot of people begin and end with Broadcom, NVIDIA, et cetera. And the point I've been arguing for a while, getting back to the argument that what's going on with AI is considerably more consequential than the Fed, is there are a zillion other companies that are derivatives of this story. And I was reading out one of them, Amphenol. I will keep going now. EQT, even with the additional capacity, the region's appetite for Appalachian natural gas remains greater than what we can currently provide. Teradyne, Tommy, Eric, Ricky.
Well, that's.
By the way,
you just made that up.
I know, but all right, we don't need to go through the list. We've been talking. We
Tango,
podcast
Echo.
every day. We've been talking about.
I don't know what the are.
We've been talking about Teradyne. We've been talking about SanDisk.
I'm not saying you're not, but
what I'm saying is, you could have had these stocks are up 300% in 3 months. This is not bullish. You can tell me that they're attached to this huge secular theme when you have stocks go up 3,000% from the date in which ChatGPT launched in late 22, and they've just gone up, 1,000% in the last year because people are starting to say, okay, I can't do this anymore in NVIDIA, in Broadcom, in the hyperscalers. That's not bullish.
Well, okay, so we're making two arguments. I didn't get to the broader market implications of it. You've cut me off several times. It's fine.
I'm sorry.
By the way, I'll throw another name in there, which I'm
now you're cutting them
no,
off.
Caterpillar is
Caterpillar.
the poster child for what you're
Because
talking
they dig
about.
the
But
holes.
Please continue.
For the data center.
No, the
They're not
turbines.
digging any holes.
Digging the holes.
Oh,
that's United
Deere.
Rentals.
That's Deere.
Anyway,
United Rentals is another one. So Dan Nathan has prohibited me from providing the viewers and the listeners with the full context.
By the way, the viewers and the listeners, they hate me. So you can say whatever you want about me.
So there are all these other companies, Vistra, Vertiv, et cetera, et cetera. So it has spiderwebbed, and now we're into the tier 3 names like Amphenol, you mentioned. No one's ever heard of Amphenol. We've heard of Lam Research, done very well. We've heard of AMD, et cetera, done very well. But now you have these, I don't want to say third tier because that implies they're
No, but it's tertiary
derivatives.
Tertiary names, derivatives that are doing exceptionally well. And not just, I get it. You look at the chart of Amphenol.
It was a $55 stock in April. I mean, it's going up 3x.
But when you listen to what they talk about on the call, there is now listen, I'm not defending valuation here. I am saying fundamentally, these companies I can't find one of these AI derivatives, whether it's Caterpillar, Amphenol, or EQT, or et cetera, that doesn't have incredibly positive things to say about demand. So getting back to something you just said a minute ago and a conversation you had on your previous episode with Mike Wilson, CIO, that's Chief Investment Officer
Yes.
of Morgan Stanley, friend of the show.
Nice job.
See what I do? I'm driving.
Yeah, we love it.
Viewership.
Thank
Driving
you.
viewership.
Thanks for listening.
Like this will end badly, probably. But as an investor, as a trader, what do I do with that?
Yeah.
That knowledge that this is going to end, that doesn't do anything for me in the meantime.
I mean, I think the visibility these companies have is real. I think Amphenol was waking up. It's like, holy shit, this is the new dawn of our company, as is Vistra a year or so. My question is, in terms of the stocks, like people are bidding these things up to levels that don't make a lot of sense. So they could have the same visibility, they could have the same numbers, but the valuation reset could be painful. Is that fair?
Of course, GE Vernova has 900 billion worth of orders this year. They had 600 billion all of last year. So with 2 more months to go,
Right.
and you see a number of companies. So what I'm getting at, leave the valuation aside for a minute. What I'm getting at is the story has spiderwebbed throughout the entire
Agreed.
economy,
100%
and is
agree
in
with that.
essentially financials are making the loans, industrials are digging the holes and providing the turbines, and you've got the energy and the power names, et cetera, et cetera. And then now in this previous quarter, some of these companies, PPG designed a product.
Pittsburgh Paint and Glass.
Nice.
Designed a
Old
product
school.
with AI. This is the first time they said they've ever done this. They used exclusive PPG data and designed a new product using AI. Visa did an ad with AI. Booking talks about customer engagement with their AI
Yeah, I
bots.
saw him on the Squawk and Friends. I think he was.
Well,
on
don't you
last week.
think that's really good that these companies are using this technology where $1 trillion have just been built out in infrastructure
Sure.
over the last year? And
Yes.
so okay, that's table stakes. You know, I'm just saying that's
Yes, the
amazing
minimum-
that one of these companies has a chat bot that works on their, online booking, service or whatever.
So initially,
Yeah.
that's what it's going to be. Facebook telling me that engagement was up 5% because they can better curate your feeds
Yeah.
using AI. And it's not going to stop at 5%. It's obviously going to go up thereafter. My point is not that there isn't overinvestment. There almost surely is. My point is not that everything's well and good when you're trading at 200 times revenues or some of these companies. My point is just when you read through the derivative trades, it's driving the market higher everywhere. This isn't just, I know we spend a lot of time talking about the MAG 7 and the 493 or the SPDR versus the RSP, but to me, it is the single biggest driver of markets across sectors, far outweighing the Federal Reserve.
Okay, agreed. What do you make of the relative underperformance of the regional banks as measured through the KRE now going on almost 4 years? And this is something that made its all-time high. I want to say late 21, early 2022-ish, and now we're trading $60. Been sideways, and that's against the backdrop of obviously broader markets done extraordinarily well. The yield curve should be working in their favor. You just mentioned the consumer, not lack of regulation, but deregulation. M&A activity, which should be there in 26, and these can't get out of their own way.
Right now, to me, and I don't spend a lot of time in the regional banks, it's not what Solus does, and I don't particularly spend too much time there, but to me, I think it's right now a loan story. There's a lot of worry about, this is an area of the market that people are very not familiar with. People don't know the difference between private credit and the broadly syndicated loan market. They don't know who's making loans to these types of companies. They see Tricolor going bankrupt. They don't know who owns that.
And they paint with a broad brush.
And so this has been worried about for a while, the looming debt bomb in private credit. And the headlines that we've seen over the last couple of months, if you will, I think is a big problem for the regional banks, just from a sentiment and a fund flow standpoint. But to your point, the one big beautiful bill, the deregulatory environment, the permissiveness.
Dan was on one of the Stephanie Rule's show last week,
the MSNBC.
and you said "big beautiful bill,"
know,
and
but
then
I
you said, "I
stopped.
hate that I just said."
Oh,
that."
you're
Anyway,
watching,
back to
guy?
you. I
What-
see everything.
What'd you think?
I pretend you always do a good job. Anyway, back to the other Dan. Sorry.
My train of thought is now
No, big beautiful bill.
the one big beautiful
Yeah.
bill, the OBBB. You can
yes.
say the OBBB. Is that better?
We have issues with Liberation Day.
I don't
with
have
one
any
big
issues.
bit-
I mean,
you
my
don't use it, actually.
I don't use any of those things. Mag 7.
No,
I
but
don't
these
use
are
any. I'm
pretty-
not a
these
laser
are
person.
particularly stupid,
These are
those two.
I think a lot of this is stupid,
Yeah.
but this is shorthand for a wide group of people knowing what you're talking about,
Right. Fair.
instead of describing the April 2nd low, which followed the tariff implementation. Just call it Liberation Day. Everybody knows what
No,
happened.
I understand. I'm just a dinosaur because I won't do that. But you're right. It's a shorthand way of getting
It's
there.
easier.
But I'm not as Dan has come to know, Bill Hockman, who's here, knows, like, I don't do things that I just won't. I refuse to do things the easy. I'm not suggesting you do.
No, I've, by the way, this is now the 4th or 5th time I've been offended since I have.
What?
Well, me was the
wait,
first
how did
four.
I offend you?
No, I've been cut off. You at one point you demeaned me.
I did.
See,
now,
that's worse than being cut off.
No,
by
I
the
didn't.
way.
Well, how did I demean you?
I've now since forgotten it. I have so low care about it. It rolled off.
If I did, I apologize. I
No.
didn't mean to.
It's fine.
Continue.
Well, here
I've
all right.
since lost where we were.
No, that's fine. We were talking about the banks. We were talking about this, that, whatever.
The banks.
Let's focus on this. We got your macro. We got your take on some of the CapEx and the contribution to the economy. And you're just showing us the second derivative, third derivative. I mean, we've been talking a lot about these. I mean, I'll just put a bow on that. I mean, Dan, you could have all this visibility, you could have all this excitement about these things. These guys just got woken up. They have all of a sudden you're an HVAC maker, and now you can sell a gazillion to these things or whatever. That's fine. That'll be ephemeral. Like, let's just be clear, because once you get this build out, then it just plateaus. You know what I mean? That is
But then you turn your attention to who builds on top of that. And I know that you were talking about this with Mike on the previous podcast. You didn't invest in JDSU. Where's Lucent, et cetera, et cetera. But Facebook and Netflix and Amazon, although it obviously existed pre.
They're using they're using that fiber optic and the infrastructure.
Just to give you another analogy, a lot of people talk about the railroad boom and what that meant. These are assets that are going to be around for a while, whereas now the GPUs are. There's the debate about whether they're usable in 3 to 5 years. But the one example I like to use is refrigeration. When I forget exactly when it was, the 20s or 30s, when you invented refrigeration, let's just say GE did it. I don't remember who. You could invest in GE and who made the refrigerators, but now all of a sudden you could make food to be taken home.
Guy's first job, he had to go down to the town square, get this huge block of ice. Remember that? And they'd say, "Little guy,
with one of
is
those
this for
crane
grandma?"
things?
Yes.
You have the big pick.
The pick. And the pick, and then he'd bring it home.
How old
and
are
then-
you? What are you, 140?
I look good for my
It looks
age.
good. All right, let's do this though. Just quickly pivoting from the AI trade to how they're financing this build. We don't have to get into all the 30% of revenue and cash flow and this and whatever.
Everyone knows
but
that.
two headlines today as we're reading. Meta's down 11.5%. So their CapEx growth is higher than their revenue growth, right? And so this is a company that has been one of the early beneficiaries of taking this technology. And to your point, it's our targeting and it's engagement, all that sort of thing, ad targeting. So now, Meta did this deal. Blue Owl, KKR, they own 20% of this Louisiana data center. It goes into the SPV. It's not on their balance sheet. Now the headline today is they're raising or getting ready to do a $25 billion bond sale. We know that Oracle does not have the cash flow, or they don't have, the balance sheet. They have to raise a lot of debt. They did $18 billion. Now they're going to do another, $38 billion or something like that. They're going to have a debt to equity ratio of like 500%. So how does this next phase of the financing, because we're hearing about CapEx, it's going to be $2 trillion in 2030.
Yeah, so we've already seen a pickup. I think last year the AI names, if you will, issued about $127 billion worth of debt. This year so far already, I think it's about $150 billion, not including some of the things that you just announced. So again, with 2 months left in the year, you've already surpassed AI-related debt issuance from all of last year. This is an important point because getting back to the AI bubble and how this ends, et cetera, if you're funding it out of cash flow, as an investor, I think or as a market watcher, if you will, there's a comfortableness I have. These companies generate enormous amounts of free cash flow. You can fund this out of that. So it's not particularly worrisome.
Okay, but question. I mean, if you've been investing in these companies for the last 15 years, all these big platform companies, they've been asset light. I mean, this is what we're talking about. So now the whole investment thesis changes a lot, right? Because you have a depreciation schedule on a bunch of stuff that you're using your cash flow to buy that didn't used to kind of work into the valuation of this company.
Yeah, one of the main arguments for the S&P's valuation being higher is its asset-light nature in comparison to the last 20 years. I mean, IP is a much more important part of S&P assets today than they were in the 90s and 80s for sure. So yes, I think that's a fair observation. I would add, obviously, putting this in an SPV and keeping it off the balance sheet to some degree insulates you as the company from whatever losses may occur.
But it's financialized and it finds its way into other parts of the financial system.
Absolutely.
Which, if it was on their balance sheet, it would not. Right?
Yeah. So, but the second point I was going to make is this is a moment when you can be a little more skeptical. So getting back to the fund out
more
of
skeptical than this,
not more skeptical than you.
Okay,
a normal person.
Be really clear about that.
Yeah,
okay.
like
a normal person.
If you were someone who was watching this go on and generally took the optimistic view of things, well, now you're in a different phase. You're in a phase where okay, well now I don't have all the money to do all this, and the numbers are all going up. It's 70 billion for Facebook. It's 90 billion for Google. It's going to be 100.
Do you think we'll look back, Dan? Sorry to interrupt you.
No,
do you think we'll look back
about
and
five
say this? Sorry for all five. Do you think we'll look back and say this was a really interesting period as we got into the end of 2025? Because a lot of the dynamics about the financing, it seems like we're euphoric. If you just look at some of the names that joined the party, we just talked about that. It's finding its way into other parts of the economy. But let's just say Google gapping up to where it did to an all-time high. The opening tick after that great report was the high of the day. Now it's given most of it back. Let's see how it follows through into next week. We saw that in Microsoft last quarter. These stocks have kind of gotten stuck in the mud a little bit, right? The biggest names, the picks and shovels.
Yeah.
So my question to you is, will we look back and say, this was a moment because now the way they're financing this, and then the headline you saw in Bloomberg last week is that Oracle, their CDS, is kind of moving out a little bit. It's widening out a little bit. We haven't heard CDS widening out because of debt concerns in a while, have we?
Yeah. So the CDS are still very low, obviously.
83 basis.
Listen, there's $9-10 trillion in the publicly traded IG market. So there's plenty of room for these companies to issue lots of debt, especially when basically they're coming from very, very low levels. And to your point about the largest stocks moving sideways, part of the argument I was going to make about the other names, the Vertivs, the Vistras, et cetera, is you're seeing a lot of money flow in there, at least in terms of the chart performance. And so I think their performance is reflective of maybe I'm a little tired with NVIDIA or Apple or Broadcom, but hey, here's again,
but aren't those names more precarious? That's the thing. It's like SanDisk. We just talked about it. It was like $50 2 months ago. Now it's $180.
The HDD companies are the two of the best performing.
Yeah, Seagate, Western Digital.
There's all sorts of other names.
They look like they cured cancer. You know what I mean?
Like, and at least, well, never mind. So yes, there are risks. I'll tell you afterwards. There are risks to stepping out on the risk spectrum always. If you think of it as a bullseye, in the middle are the safest assets, and the further out you go, you're in theory compensated with a higher risk premium or higher returns by taking more risks. So yes, if you get into a smaller company trading at a higher valuation, I mean, how many times have we said the big names are not particularly expensive, Google, et cetera? So yeah, you're taking a bit of a risk. Again, but from an investor standpoint, I don't get to complain and say, oh, I don't like this. I've got to invest. People don't give Solus money. And if you're another asset manager, you don't get money to buy the spider or to put it in treasuries. You've got to invest in whatever it is that the strategy, in whatever strategy you employ. And so sort of like it's a version of the Rumsfeld line, you go to war with the army you have, not the one you want to have. This is the market. And you've got to figure out how to make money in all markets, including this one.
I think Rumsfeld went to Princeton, if I'm not mistaken. Not that anybody
Woodrow
cares.
Wilson School of something or other. Yeah.
What do you make, if anything, of the recent underperformance of Bitcoin? Is that just anything like I'm watching Bitcoin as sort of a risk on, risk off type of thing, and I'm watching how MicroStrategy now is trading. I'm watching Bitcoin below 107. Am I looking too closely for something, or is there something?
Everyone's going to give you a different answer. I'm
curious as to what yours is. Do you follow it all?
Yeah, we pay attention to it. We've been around Bitcoin in some of our investments. I don't know that it tells me anything that the broader risk landscape isn't telling me. I find it to be just a risk derivative, if you will, of the NASDAQ. Or
I agree with that.
Yeah. So obviously there's the spending and the same issues with gold, et cetera, but in general, short-term moves in those types of things, I tend to, especially Bitcoin, I tend to sort of fade as an indicator.
All right. So last question here, Dan. What is one question, forget Solus investors, forget your friends, your fancy friends on CNBC and your folks in the business. What is one question that you most commonly hear from folks who are just invested in the market, but they don't look at it every day like we do and everything. Because I know they look at you and they think you're a really smart market participant,
They're
that sort
right.
of thing. And they would be right.
Yeah.
But I'm just curious because I always like to get the, like, we get a lot of these questions and, guy asked Bitcoin, 5 years ago, everyone's like, what's cryptocurrency? Should I be in it? That we hear that much less now. I'm just curious, like, what do you hear? Is it about AI in general? Or?
So I get three off the top of my head, 3 questions in general. The first one is always politics.
Really?
A lot of always
in terms of its import of in terms of the market,
the market and what's going on in the world. Some version of you can imagine what type of question
I can't imagine.
you might get. You get a lot of politics questions. I would add probably the thing AI obviously. I'm thinking about adding to NVIDIA. What do you think? I of course can't answer that,
Right.
but probably the big, and I think I talk about this all the time when I speak publicly. Probably the thing that I talk about the most, and I say it's surprising because I live in Manhattan. I'm relative to the average person doing fine economically, and the people around me are above average income earners. The pervasive conversation is inflation. The pervasive conversation,
even among
people, will say, I don't want to say of means, but people who are fine and not struggling. And if eggs go up $1, don't blink. They just notice it went up $1. The conversation I get all the time is about the price of food, about the cost of steak at the restaurants we all go to in Manhattan, about the cost of the food delivery services, the luxurification of everything that we lament as it weighs on the lower income consumer. I know plenty of high income consumers who are just, how much is this
the sticker
cantaloupe?
shock it's pretty. So does that suggest it's still a problem? Or are they asking you in terms of, is this going to abate? Like, where do you think it's coming from?
Well, a lot of it is just people who can't believe that something not that long ago, we can remember 2020. It was not that long ago, was $1 and now is $2. And when you add up your consumption basket in the store, you might have to spend, and again, I apologize if other people don't relate to this, but your food basket might be $200 instead of $150.
All right, so let's bring it all the way back around to what we started talking about in this kind of push and pull with Fed Chair Powell, right? So weakening labor market and inflation that's sticky. I mean, you just made a case for across the income spectrum how this is kind of weighing on folks. Do you think this is going into the new year, no matter who that shadow Fed president is this going to be something that you can't sugarcoat what's going on? People see it right in front of them. So is this going to be the thing that really keeps the Fed in this like nonstop debate about what to do going forward?
Well, remember, prices on balance, your basket does not go down.
Yeah.
Individual prices go up and down. Your basket of goods don't go down. When I went through this at Solus a couple of years ago, I used the price of the porterhouse at oh my God, what's the steakhouse in Brooklyn that we all used to go to?
Peter Luger's.
At Peter Luger's. I found menus intermittently over the last 20 years. Price always going up for the price of a steak at Peter Luger's as a representative example.
Does the steak get better year over year, you think?
If anything, it gets smaller.
Yeah.
That's shrinkflation.
That's what she said.
So, oh boy.
You went there, not Dan.
Well, we'll
Greenhaus.
keep that in there. We'll keep that in there.
So I think it is an argument I've been making in some of my posts, like publicly, is the politician that figures out that housing and the cost of living is the single largest issue.
Mamdani just figured
and
it out.
I was building up towards
okay.
Mamdani is
So you interrupted him for the 7th time.
It's a conversation. If we were at Peter Luger's, wouldn't this the way the conversation
We're not
would
at
go?
Peter Luger's.
we could have a steak here,
Next
but you're
time.
not great hosts.
Standing table.
So
fair
I
point
just
by you.
whatever one thinks about him, and there's plenty to think. The push for affordable housing, I'm not at all surprised that it resonates with people in New York City, and I think the rest of the country is obviously it's New York City, so it gets national attention. The rest of the country is paying attention, and if you think this is the last guy or girl to show up talking about let's get the fat cats and freeze the rent, if you will, I've got a bridge to sell you.
Yeah, that's Dan Greenhaus. We love having him here, despite the fact that we interrupt him relentlessly.
All right, but you know what? We're just going to have him back really soon.
We'll have him back.
And then if we just kind of put it all together, it's like much fewer interruptions, more time for you to speak.
That's fine. We'll see what the 25 to 50 year old.
Oh, by the way, so rather than a set of steak knives, when he gets to his 10th episode with us, he gets a free dinner at Peter Luger's with us.
I've been to Luger's probably since the 80s.
Yeah.
I mean,
Really?
Yeah.
Oh, I like Luger's still. I think it's a good.
No, it's
old
a
school
place to
spot.
go.
Yeah.
But it's legit 80s, and that's a long time ago.
Yeah.
But you also don't go out at all, correct?
From time to time.
Well, we went to Keen's together with
went to
Peter and
Keen's.
Danny.
Yeah.
We had a great dinner. That was fun. Guys,
Largest
have a ball.
pipe collection.
It's
I think, in the
amazing.
United
That's
States.
if you were listening to this and you don't live in New York City and you're going to come on vacation or whatever, and you're looking for the quintessential steakhouse in New York
Sparks.
City,
Sparks probably
go to
still,
Keen's.
because of the murder.
Sparks is the place.
People
I was
will
going
pro-
to Sparks. We used to go to Sparks. I wouldn't say once a week, but we'd be there a few times a month back in the day.
You and your people.
It was great.
Guy always had his
We
back
ordered-
he always had his back to the wall.
We ordered the
and then we
lamb
walked out
chops,
of
which
there.
are not on the menu. You can get lamb chops there as an appetizer. A lot of people don't know this.
I will say one of the worst parts about getting older in financial services, and I'm sure this is true in other industries as well, is you spend so much of your mid-20s to mid-30s making friends all around the country,
True.
going out to dinner, to football games, to concerts. It's a huge portion of your life. And then you wake up one day and you're old as we are, and you don't do it nearly as much. And it is a shock to the system.
Speak for
Well,
yourself.
Dan's out every night. Nathan Dan, not Dan.
Well,
Greenhaus.
Dan Nathan has way more friends than both of us then.
No,
That
I
might
mean
be
it's
true.
more about just kind of going and going. You only got one go around here, Guy Adami.
Life
You know
is
what
not
I
a
mean?
dress
I
rehearsal.
actually don't know what I'm talking about because I'm actually going out to dinner tonight with about 5 people.
All right, my man. Well, listen, Dan Greenhaus, next time you come on, after that, we're going to do dinner. We appreciate you being here.
My pleasure, guys.
Wait, what?
He said, "My pleasure."
What? I was just interrupting you.
My
All right, we'll cut that. Thanks for being here,
I
Dan
thought
Greenhaus.
we agreed that I would be doing the jokes.
Ah, jeez.
You should have, as it turns out. Thanks, Dan.
Thanks, Dan.